the broadcast. I have that. Do you see it up there?
Yeah.
The broadcast is now starting. All attendees are in listen-only mode.
Well, good afternoon, everyone. First, let me thank you all for attending our Self-Funding 101 webinar today. For those of you I have not met or spoken to, my name is Christy Saul, and I am the Vice President of Marketing for URL's Disability and Special Products Division. For those of you who might be unfamiliar with URL, we are a family-owned full-service brokerage firm offering all lines but property and casualty, and we have been in the business for close to 30 years now. We do license thousands of brokers and general agencies all over the United States, and we are partnered with hundreds of what we believe to be the best insurance carriers in the market today. We do have very distinct divisions here at URL, which include individual health, group health, senior care products, annuities, life insurance, ancillary products such as disability, accident, critical illness, cancer, and group worksite products. We have case managers to help you work smarter, not harder, by following your case from submit to issue. So essentially we will run pre-screens for you, run the quotes, and keep you posted 2 to 3 times a week on case status. And if for some reason the case is declined, we will shop it to all of our carriers. We also pride ourselves in a very diverse product portfolios and helping agents learn how to cross-sell in our different departments. We essentially want you out there doing what you do best, selling and not worried about quoting or status updates. So we essentially want you to consider us your back office. With the changing times in the healthcare arena due to Obamacare and commissions being cut or not paid at all, now is the time, as I always say, to diversify or die, so to speak. So if you have not written anything with URL, I urge you to give us a try at your first case and let us really earn your business. This is our website, and I'm not going to go into great detail, but this gives you kind of a heads up about all of our different departments. Right here, if you would click on these, it would get to all the different departments. Gemini is kind of a new endeavor for us, and I encourage you to get on the site and actually look at the Gemini project because it's really exciting. And just down the bottom you can see how does Gemini work. It's very simple. If you write business with an insurance company that we represent, we ask you to place that business with us. If we don't have that contract or there's a need to place business with a company that URL does not represent, then there's no expectation that you place that business with us. But if you do become a Gemini partner, there's a lot of perks that go into it. We guarantee that we will match the commission you have with another carrier, if not do better. We do exclusive quarterly bonuses with the Gemini plan. We give you free E&O coverage. We have a group health pool bonus, exclusive lead programs through our life department, an annual retreat, and just a lot of perks. So something I'd like you to take a look at is our Gemini plan. Again, I urge you to give us a try with your first application. Today we're going to be covering Starmark self-funded group plans. The trend for group insurance is really moving to self-funding, and we're seeing a huge pickup in sales and employers and their agents thinking outside of the box, so to speak. So the question to ask your employer clients is, how much money did the traditional carriers give back to them at the end of the renewal year? Well, the answer is 0. With self-funding, Gino Gambardello, who is a sales consultant with Starmark, will be doing the presentation today, so I'm not going to steal his thunder. So I'm going to hand over the presentation to Gino in just a minute. Everybody is muted, but there is an area where you can type in your questions, and we will get to all the questions at the end of the presentation. So without further ado, I'm going to hand this over. Oh, I don't see Gino. Deb, do you want to do the PowerPoint?
Yes, I'll do that.
Okay. Because he disappeared.
No, I'm right here. Can you hear me?
Well, I can hear you just fine, but
yeah. Okay. You don't see the yeah. I clicked OK, so I'm trying to see where the there you go. Screen sharing. There you go. Let's see if that works. I showed that I'm on air now. Can everyone see the first slide there?
No.
No.
I'm making Deb the presenter, so hopefully she can pull it up. There we go. Deb, is that you or is that Gino with the PowerPoint? Okay. Gino, can you see the screen?
Yes, I can. Yep.
Perfect. Go ahead.
Okay. Well, thanks. So I guess Deb is going to be navigating the pages as I talk, correct? Okay. So so we are going to page 2. We are Starmark, and we are the leader in small group self-funded. We started this business in around 1985. We provide healthcare benefits for small to mid-sized groups, and the way this self-funded works is, as you may or may not know, we'll get into more of this, but basically it's self-funding with stop-loss insurance. Our stop-loss carrier is Starmark, who is a company that's been around for 100 years. They have a A-minus AM Best rating, which is excellent financially, and we have over 2 million covered lives. Next slide. So basically with this product, otherwise known as Healthy Incentives or Healthy Edge, we have a lot of flexibility in terms of what you can do with this product. It acts and feels just like a regular standard insurance plan, except it's a lot more flexible, and it also can afford certain group types, a very beneficial discount when it comes to premiums. So the way this thing works is there is one payment that they make every month, just like they do with regular insurance. There is an opportunity to actually get money back. We send them reports, I think 3 or 4 times during the course of their plan to show them how their dollars are being spent on medical health insurance. And it gives them a lot of visibility that they probably would never get otherwise in the traditional carrier market. Next slide, please. So as I mentioned, there's a lot of flexibility with this. There's literally hundreds and hundreds of combinations of plan designs. I know since the Affordable Care Act has kicked in, many of you in dealing with your groups may have run across some frustration in that there's limited plan designs, typically a lot of high deductible plans, high co-insurance, just to get the costs within range that's affordable for these groups. So we can do all kinds of different plan designs, as you can see in the chart here. We can do different co-pays, different deductibles, anywhere from platinum plans down to minimum value plans and anything in between. We also do HRA administration, and I'll talk more about that down the road here as an opportunity to maybe even expand your business. But we do that, and we also do it at no additional charge. Next slide, please. So the way the self-funded plan works, basically, we can do any size group from 10 lives to roughly a couple hundred. Theoretically, we can actually do a little more than that, but only because of the limitations from a practical perspective, that kind of puts us at a limit of about 200 lives. For groups of 10 to 120, we use the Aetna network. They don't allow group sizes above 120, but for groups above 120, we can use Cigna or Aetna. And typically, when we do quotes through URL, the zip code is what determines, which particular network may have a cost advantage. So you can see quotes either using Aetna or Cigna, or if there's a preference for one or the other, we could always switch to the preferred network. The minimum group size is 10. As I mentioned previously, there's plenty of different kinds of deductible and copay options that we can put together. These are strict PPO plan designs, which of course means there's in-network and out-of-network benefit, something you folks probably don't see too much of anymore these days. We do have dual plan designs available. The plan designs can be on a calendar year or a plan year deductible. And the options in terms for copays do include physicians, specialists, urgent care, and so forth. And again, we also can offer an HRA at no additional cost. Next slide, please. So the way the self-funded plan works, it's really pretty simple. You can see here the first 3 bullets. There's basically one fixed premium. Those 3 elements are broken down into stop loss. Stop loss is the amount of is the amount of premium or the part of the premium that's paid in case the amount of collected dollars that we put aside to pay the premiums is exceeded. And then the third part is the admin costs. So the three parts again is the actual claim pre-funding, the actual dollars extracted from the premium put aside to pay the claims. The second part is the admin fees just to administer the plan, and then the third part, critical to the plan, is the stop loss, so that if the claims go above some expected or underwritten rate, there's never any more liability for the group except for the premium. And again, the icing on the cake is that should there be money left over, and typically there is, that would go back to the group. The funding, the claim pre-funding is put into a special bank account, and that's where the claims are paid from. Everything is done on your behalf. Stop loss insurance kicks in if the expected claims exceed the expected claims are less than what the claims that are presented. And at the end of the contract, we determine what amount of money there may be left in your account, and we'll either apply that toward a credit toward your renewal, or we'll send you a cash refund for that amount as well, depending on the surplus option that's chosen when the plan is designed. Next page, please. So here's a typical plan design that I'll walk through with you to kind of talk you through the elements of the plan. I know self-funded may not be very familiar to some of you, so if you do have any questions as we go along here, please, you know, as Deborah indicated earlier, just make a note and maybe put it in the message center on your lower right-hand screen, and I can answer those questions when we're done. But here's a typical plan to simplify going through it. This is a high deductible a plan, which is basically an HSA qualified plan. So after the deductible and the coinsurance, here in this example, $2,500 deductible, 70% coinsurance, everything is paid for from that deductible, and then once the deductible is met, everything's paid for with the coinsurance. Next slide, please. So here again, breaking down the cost in the upper left-hand quadrant. Here's the monthly cost. Broken down by the four tiers: employee, employee spouse, employee child, and full family. Some of you may have a refreshing sense in seeing that again. As you know now, with the age-rated, band-rated quotes and proposals, it gets pretty mind-dizzying to see all the different rates. But with us, it's still a simple four-tier, and it makes it very easy to allocate the contribution that the group's going to have for the plans. On part two, this breaks down the monthly cost by those three elements I talked about earlier. Again, the monthly fixed cost for this one is a simple $21,896. That's a fixed premium. Again, broken down as you see there with stop loss, admin fees, and claim pre-funding. If you take a look at the red arrow pointing to the claim pre-funding, that is on a monthly basis. If you take that monthly basis, multiply it times 12, you get a value in your lower left-hand quadrant of $88,258. And that amount is what's known as the aggregate attachment point. And what that means in simple terms is if the group's claims exceed that amount, then the stop loss insurance kicks in and we cover any claims above that. So that's pretty much how it works with the stop loss. It's pretty simple. The specific deductible that you see there means simply that no one person or no one belly button can actually extract or deplete those aggregate claim dollars by more than $20,000. So if you have one real sick person and the rest of the group is really healthy, that one person, even if their claims are $100,000 or $200,000, the most we will take out of that $88,000 is $20,000. So theoretically, that leaves about $66,000 that the group still has. And if there's minimal usage on those claims, then they could get a good chunk of that money back. So that's pretty much how it works in a nutshell. Next slide, please. Here is a sample of a typical quote that you'll get from URL. Basically, it shows this is a claim. Is there a page 9, Deb? Could you go back to another page? I think there may have been one before that. Mm-hmm. There you go. So here's the first page of a quote that you typically would see. Every proposal can have up to 4 plan designs, summarized very nicely here, as you can see. So depending on which plan you want to talk about, all of the proposals are broken down in the same way. The first plan is plan 1, and then the subsequent pages and in the proposals that you would get show the benefit summaries as a second segment for each plan design, and then after that would be the actual plan summaries in terms of stop loss and ad cost and all that. So that's how they all break down. So next slide, please. So here's the benefit summary. So that this one relates to design one. It just elaborates in more detail the summaries that were pointed out on the first slide. Next slide, please. The next part of the element for the proposal for that plan one would be the actual self-funded health plan design summaries that shows the metrics in terms of the cost per employee spouse, shows the cost per tier as you see there. It also talks about in the middle of the page is what's called the cash surplus. This is the amount, as we mentioned earlier, this is the option that they have. They can get 100% cash surplus back to them, which is what this option shows. They can have a 2/3 credit or 2/3 applied to their renewal, or 2/3 return to them in a rebate if they don't renew. So there's all kinds of different options that we can apply depending on the preference of the group. But at the end of the day, most of these plans do allow for some kind of return on the plan premium. Next page, please. So here's another breakdown that shows even in more detail how the plan breaks down, and it allocates the actual cost for the different elements of the design: the stop loss premium, the claim pre-funding amount, and the actual claim dollars. One thing this also shows toward the middle of the screen is called an aggregate corridor, and basically this is the actual amount of money that we add a 25% corridor, which means that beyond the expected risk for the group, we actually put a little buffer in there of 25%. So under ideal scenarios and under a perfect theoretical model, the group would typically get 25% of whatever claim dollars back returned to them based on whatever their surplus option is. So sometimes, of course, they will get less, sometimes they could get more, but again, this is just based on a theoretical mathematics or actuarial mathematics of how these things work. That corridor is built in there, and that's a good thing. Next page, please. So with us, we make this very simple in terms of how you get to do a self-funded plan. Well, the beauty of the self-funded is that it allows groups to extricate themselves from the tragedy of the Affordable Care Act because of their high premiums, and if they're relatively healthy and they see the value in the self-funded and how they could save money, there is some underwriting that has to take place to validate the health status of the group, and we do that very easily and very simply. There's two ways we can do it. We pretty much do not do paper apps anymore. As you all know, paper applications from the old days are a hassle. They're cumbersome. A lot of employees do not like to expose their PHI information on paper apps. So with our platform called Express Connect, they can do it by phone or they can do it online. It's very simple. We set it up, and then we send the URL and you guys an update every day as to the progress of that application process. And by the way, the application process is also the enrollment process, so it's killing two birds with one stone, and it works very easily and very nicely. Next page, please. So why would you choose Starmark? Basically, as we kind of talked through in previous slides, we are one of the leaders, if not the leader, in self-funded plans. We have very flexible designs, great rates. We process claims in a very timely and accurate manner. We do the enrollment with the Express Connect platform, which makes it very easy and very hands-off for the broker. Just great service from our customer service team. We took surveys from different brokers throughout the country. We have documentation, and we kind of tried to document how our service is rated. We have more than 25 years of experience, and of course, Trustmark itself, the stop-loss carrier or the stop-loss company that actually provides us the stop-loss part of the product, has been around for under 100 years and have that A- or excellent rating financially. Next slide, please. So you may be wondering, what target market can we focus on? And here's a list of them. Now, some of you brokers I know probably, just like to do your, keep your current groups healthy and whole and want to keep them happy and always trying to figure out the next best thing for them to help them save money. For you guys, and also for folks that maybe want to go beyond that, if you want to try to target some more groups, some more business opportunities, these are the kinds of key markets that our self-funded applies to. And typically these work better because they tend to have a younger workforce. The most successful demographic that we've had most success with happen to be in the information technology, computer technology arena. They tend to hire a lot younger people. So that works really well. We've written several groups for landscaping, again, younger, healthier young men. So this is a list of industries that could fit that profile. Just as a note, I'm sure you guys probably can think of some others as well. Next slide, please. So besides the self-funded option and what it affords you and the group in terms of thinking outside the box and providing great medical coverage for their groups, we also do a couple other things that can make it even more compelling for you. As I mentioned before, we can administer an HRA. We can do it seamlessly because we are also not only the medical TPA, but we would be also the HRA TPA, and there's no cost to do that. So keeping that in mind, the other thing that we can do in today's rough world of the Affordable Care Act, a lot of groups now are having trouble, as the second bullet points out, meeting the requirements of providing some kind of coverage to their groups. So with that, there's what's called MEC plans, otherwise known as skinny plans, that can help get them off the hook or mitigate their penalties by also allowing the groups to participate in the MEC plan, and the MEC plan combined with the minimum value plan provides the best possible scenario for them to minimize their cost in terms of any penalties and at the same time provide their group outstanding insurance coverage. Next slide, please. So going back to the HRA example, I just wanted to point this out for maybe some of you folks that like to sell HRAs and HDP type products. There's three different kinds of HRAs. There's the advanced HRA where the employer is going to reimburse the first part of the deductible, if not all of it. There's a bridge HRA, which basically the center part there where the employer is going to basically fill after the deductible is met, he may provide the reimbursement for the second half, and then the third part is a shared HRA, which basically they're going to split the cost of that deductible up front. And the reason why I want to point this out, if you look at the green box at the bottom, if you couple an HSA or high deductible plan with an HRA, you can pretty much offer an alternative to a gold or platinum plan. There's not much of them out there, but there are still a lot of groups that prefer to have very rich plans for their employees, but they're just very expensive. Well, a way to approach that is this. If you offer an HDHP, let's say a $2,000 deductible plan with 100% co-insurance, and you do an HRA reimbursement, then basically the cost of that plan would be much, much lower, because typically in the standard plan where your traditional carriers and non-HRA plan, the entire premium risk is built in, so that's what hello? Are we okay? I'm sorry. Okay. So I just thought I heard somebody ask a question or something. So where we have this plan, and you have an HRA to go with it, you can save quite a bit of money. And I'll show you on the next slide how this could work. Next slide, please. So this is just an example. If you wanted to if you have a group that has a platinum plan, you're not the broker of record, and you want URL to help you perhaps present a solution that could help them get great benefits, you might want to suggest the HDHP with an HRA. Here's a typical profile that we could send to you. Basically, this charts the difference in the cost savings between a full traditional plan, in this example, costing $154,000, as you can see in the middle of the screen on the plan on the left side, versus $84,000. And the way this would work is you would use this plan. It reimburses $40,000 in HRA. So on this lower left-hand bar graph, you can see even at 100% utilization, if the group had to reimburse the entire deductible, this person would still be saving about $29,000, even if they had to reimburse the entire HRA allotment or commitment to the group. Typically, HRA reimbursements do not run more than 50%, so this would be typically a plan that would be outstanding. And beyond that, if you take a look on the right side of the middle of the screen where it says under help, there's another graph there, another little matrix that shows the actual max out-of-pocket for the employee. Not only does this plan save money, provides a silver, platinum, or gold plan, but also minimizes the max out-of-pocket expenditure potential for the employee. So you can see in this case, with this kind of a plan, the MOOP exposure for this plan would be $0, whereas for the other plans it would be $3,250. So you have all these different elements contributing to something which could be very compelling if you wanted to go ahead and try to use this tool to think outside the box to perhaps capture more groups. Okay, next slide, please. The MEC plan is, again, something that we can put together, otherwise known as a skinny plan. And some of the parameters of how that works is coming up in the next slide here. So these are really low-cost plans. Typically, they run, anywhere from 70 to 120 bucks. They have to be sold in conjunction with a regular standard plan, and there has to be at least 10 enrolled in the MEC plan and 10 enrolled in the minimum, the standard plan. But again, they can work really well if a group is having a hard time trying to provide some kind of coverage so that they don't have to endure the hard penalty and just want to get by trying to avoid any of the employees going to the exchange to get insurance. And by doing that, they can save some money, and this is one of the ways they can do that. Next slide, please. So the three plans we have for preventive care, these plans are all preventive care, but they're the MEC plans. There's basically three options. One is just pure preventive care. In the first column there highlighted. What's included in that, though, is teledoc, which is unlimited for $40. The employee can go and unlimited, contact a doctor by phone. If, little Johnny is feeling sick before school, they can get that service unlimited for $40. The next package one, is a little bit of an extension. It also provides 3 physician visits at a copay of $20 per visit, or per year, I'm sorry. And then, so that's, one up from there. And then the final update or upgrade would be the third plan design, and that also offers 1 ER visit. So they're all MEC plans, just 3 different levels, but the most basic one, the cheapest one that probably would work if this is positioned to want to be an option for a group just to avoid the hard penalty, is basically to use this first plan, because that is the cheapest. They run, pretty $70, $80, $90 maybe, and it does provide a way to mitigate those penalties. Next slide, please. So again, this is a little bit, I may have said some of this already. So again, this is a plan that has to be used with either Healthy Edge or Healthy Incentive, the standard plans. And by the way, just like in the traditional plan, there are cashback or any amount of surplus cash dollars get refunded. The same holds with this plan too. They're actually run as 2 separate plans, although they're for the same group. But there's different AGs, different claim dollars for this and different claim dollars for the other one. And at the end of the day, even this one, if there's any surplus, it gets rebated back to the group as well. So not a bad way to go in terms of trying to reduce costs. So to finalize or kind of wrap things up here, to get a quote from URL is really pretty simple. Christy and Deborah are very familiar with this. We've done many quotes together, but for the benefit of the audience, step 1, provide the census and plan designs for the group that you want to quote. Provide once they get the quote or the base quote and they want to move forward with the questionnaire. As we mentioned before, we have the Express Connect platform, which enables them to answer the medical questions very easily, either by online or by telephone. Once that's done, in step 3, assuming they like the final rates, then we simply have to fill an employer app, get a copy of the prior carrier bill, and some other minor documentation, and we move from there. And once we get that back, we submit the offer letter, and once they sign that, we give them a group number. So it all works nice and simple. The Again, it's the turnaround time for underwriting is about 24 to 48 hours, or roughly 2 to 3 days probably. This is a sample of what the ID card looks like in the next slide. Yeah, so this is a sample of what the group actually receives. It looks, just like a regular ID card. It's got the Starmark logo. It's got whether it's a Aetna or the Cigna network on there, CVS. So that's what the card looks like. And that is it, except for one more slide, I think. So again, hopefully, this is giving you some more insight into our self-funded product. URL is great to work with. I've been working with those folks now for a couple years, so please feel free to reach out to them. And any questions or comments or any other follow-ups that I need to do, I'll be glad to service them through URL. Thank you for your time, y'all.
Thank you, Gino. We do have a couple questions that came in. Fantastic job. I appreciate it.
Sure.
First question, and I'm going to let you answer these questions because you're the expert, but the first question is, doesn't PA require at least an aggregate of $100,000?
No, that is not. That was true about, I would say, 2 years ago, but that's no longer the case. That is gone.
Yeah, I can tell you this though. I mean, for everybody who's still on the call, that and we've talked at length at this before, that I know that's not the case anymore in PA, but I would say every other self-funded carrier is still going along with that, whether they have to or not. So it doesn't make them real competitive.
Right.
Okay. Next question is, how does the Express Connect component work? Is there a cost for this enrollment?
Absolutely not. Express Connect is totally free, and it is totally easy. The way, in a nutshell, the way it works is once you give URL the go-ahead that a group wants to do the Express Connect, you would get an email that outlines basically the simple procedure in a few sentences, and then in that email there's an attachment. If it's online, it's an online which shows a web link and an ID code. If it's by telephone, it shows a telephone number and an ID code. You just call in or you log in, register, and then you just start answering the questions. And then every day we provide a progress report back to you to see how that progress is coming along. And then when we're finished, we close it out, give it to underwriting, and then within about 48 hours we'll get the final rates. Very simple, no cost, easy to do.
Yeah, and I can attest to that because we've been working on a few groups, and Starmark, and I'm not just blowing smoke your way, Gino, but
okay.
You are I will blow smoke your way though, but you're amazing to work with, and you're, I mean, right on the ball. And we're working on a group right now that we're enrolling with one of our agents, and I come in every morning and I get a very detailed report on what exactly is missing, what is needed. It's just, it really is seamless. I think the only holdup sometimes are that, some of the employees don't get around to calling in or logging on, but as far as your end, it's been amazing.
That's great.
Yeah. So I have another question. They're rolling in now. Next question is, I have a 20 to 30 employee group based in Hagerstown, Maryland. Ooh, and PA. Can you cover them with an Aetna plan?
Yes, we can. Absolutely.
Okay. Okay.
So they have, just to clarify, I guess they probably have the headquarters in Maryland and they have employees in Pennsylvania. Is that what it sounds like, Christy?
It's sounding like they're based in Hagerstown, Maryland, but they have employees, I just reread it, in Maryland, West Virginia, and Pennsylvania.
Yeah. Just to clarify, just to make a point, that's a great question. So another thing we do is, as long as the headquarters of the group is in any state that we write in, and that's virtually almost all of them. I think we're in like 48 states. So that group, wherever they're headquartered, if we write group health or self-funded in that state, they can have employees anywhere in the country, and we can write that group. Even if there's no employees in the headquarters and they have group employees scattered throughout the country, we can still write that group. So, yep. And I think other carriers require at least 50% be in the contracting state, but we do not have that requirement. So, good question.
Okay, next question is, can you elaborate on the MEC plans combined with the metal plans? Has the IRS approved this concept as a way to comply with the ACA rules for both employees as well as employers?
Yes, great question. The MEC plans, otherwise known as skinny plans, they are right now, they are a technical loophole for groups to mitigate their mandated penalties. Whether Congress will prohibit that down the road is, remains to be seen. But right now, a MEC plan, if somebody only offers a MEC plan, and that's all they offer, right? Since that doesn't meet minimum value, that group still, because they're offering at least that, is only relegated to paying either $3,240 per employee that goes to the exchange and gets insurance. If they had offered no insurance at all, not even a MEC plan, then basically they would have to pay $2,160 for every employee, even if just one employee went to the exchange and got insurance. They would be penalized for their entire group. But once you offer at least a MEC plan, that mitigates that hard rule, and then it relegates to the soft penalty, if you will, where that really, in that case, the soft penalty for every employee that goes to exchange, then you have to pay just per employee. So that's the difference. And again, it is kind of a loophole, but that's the way it works right now.
Okay, thank you. Next question is, how does this work with high deductible health plans that have a lot of employees enrolled with dependent coverage? Those employees have zero benefits until the family deductible is met, question mark.
Yeah, this is great. This is a great question, because this is what I was alluding to earlier when a way for a group, and the reason why groups have high deductible plans is because they can't afford much anything else. But if a group wants to have a high deductible plan, they can do that with coinsurance. So one of the things that can be done is you basically put an HRA in place where the employer is going to reimburse part, not necessarily all the deductible, but just part of it to help the employees get by. Because typically, if you have a $5,000 deductible, typically, if somebody does have to go and have some kind of minor medical service performed, they're not going to use maybe more than $1,000 or so. So if the employer is generous enough and provide an HRA to reimburse that amount, that's one way to go. But beyond that, I mean, a high deductible plan is, again, a lot of plans are going at high deductible only because it's, it's so expensive to do anything else these days.
Okay, thank you. Next question is, what percentage of groups have gotten a rate better than ACA group rates, 10 to 50 group size? I don't know if you can.
Yeah, I don't really have statistics on that. But I would say the standard. I would say that the standard base rate for self-funded in any particular zip code and demographic is probably, much less, or at least somewhat less than what they could get otherwise.
Yeah, and I can say that with the quotes that I've worked with you on, with our brokers and helping our brokers present the self-funded concept to their, the employer clients, is that, again, it always depends on the group, but with the huge renewals coming in, we've been seeing lower rates. I would say anywhere from 10 to, in certain circumstances, 30% less than the renewal rates, with kind of mirroring the same plan that they have, but again, that potential to get the money back. And there's so much flexibility that, I mean, Gino and I just got through with the group. You know who I'm talking about, but
right.
I mean, and we went back and forth, and the beautiful thing about self-funded is that it's so flexible that a rate came back, and then, we took it to the employer, and he said, well, I don't know. So then we kind of, as he had mentioned before, you can change that, that claims bucket where we started out with a quote with, okay, the employer can get 100% back. And then we went back to the drawing board and said, okay, let's see the premiums with him getting 2/3 back, and that's the one that sold. So it's a very flexible plan design, and that's the beauty of it, I think. So,
yeah. Well said. Thank you.
Oh, you're welcome. Next question is Express Connect available through all brokers who sell/offer Starmark?
Yes, it is.
Next question. How far in advance of the effective date can we begin the application process?
Great question. Actually, the sooner the better. I mean, if you want to start the application process even 6 to 8 weeks ahead of time, that's great because, like Christy alluded to earlier, a lot of times it's not so much getting the thing rolling because we do that very quickly and efficiently. We provide the feedback efficiently. It's getting the employees to get that mojo going to actually go online or call in to do their medical questionnaire. So the more time we give them, the better, although that could be a double-edged sword. If we give them too much time, then they can get lackadaisical. So typically, we try to make it, about 2 to 4 weeks. We try to start the process, give them about 2 to 4 weeks to enroll. So we really should start at about maybe 6 to 8 weeks ahead of time for, to get the actual medical questions completed.
Mm-hmm.
And I know that,
yeah, and I know that we're dealing with a group now that we started a little bit too early and they got lackadaisical. And, for each group, I know you send out, very specified personalized links for their employees, and there's an amount of time where the link kind of expires, right. And sometimes we have to go through the process again. Right. Okay, next question is, what is the lowest cost MEC per employee per month plan? I'm not sure. Yeah, it's a hard question to answer because they do vary, but they are very low plan designs or costs. As I mentioned before, they're basically only preventive care, and I think I've seen a couple, again, depending on the zip code and the different demographics. Of course, there is no underwriting. It's just we just get a census spreadsheet, whoever wants to enroll, and we enroll them. But the cost can be, I think I've seen as low as like $65. For the basic plan, the basic MEC plan, but I think I've seen it as high as maybe 100. So it depends on the demographic and the zip code. Okay. Next question is, I think I can answer this. Return of premium is of the claims bucket is 2/3 of remaining balance. Starmark keeps the additional 1/3. Well, that's a choice of the employer. Because the employer, if there's claims left over, the employer can choose when you quote it out to get 100% back. But if they choose to only get 2/3 back, then of course you're keeping the 1/3. So, right. Yeah, I mean traditional carriers keep all of it if there's anything left over. Exactly. So, right. Yeah, so I mean we could split up any way the employer wants. They can get 100% back, or depending on the premium, mix it up. Next question, which I forgot to touch on earlier, but thank you, David, for asking this question, because the question is, can a self-funded plan be combined with a gap plan? Absolutely, and I had a note to mention that earlier and I forgot, but that's exactly, when I work with brokers, that's kind of my selling point, is to give the presentation of a self-funded plan because of all the benefits of it, and then throw in a gap plan, because that gap plan, a group gap plan, is going to cover that claims bucket and protect it. So the gap is going to pick up first dollar, before anything else kicks in. So it's a really great selling concept, is to sell a group gap plan with a self-funded. I think that's really the only way to do it. I mean, not that self-funded isn't great, but again, the gap is going to protect that claims bucket, so your employer client is going to be more able to get money back from the self-funded plan at the end of the year. Next question is, what is the commission rate? Dave, I don't like to give out commissions over the phone, so I can contact you or shoot me an email or give me a call. The commissions can be flexible depending on the group, but they're good. That's all I'm going to tell you. They're good. I think if anybody has any more questions, please type them in. But I think we've gotten through just about all the questions, and I think it may. Anything else you'd like to say, Gino, before we end the call? Yeah, no, thank you, Christy, for hosting this, and I really appreciate the time and the time that everyone that's called in, to participate and ask questions. I really appreciate it. I hope we can help you out and grow your business together. Yeah, I appreciate your time. Great presentation. And for everybody on the call, I appreciate your time being on the webinar today. And please contact me with any quote requests you want. Starmark does a great turnaround on quotes. And again, you know, great carrier to work with. And I appreciate all you've done for us. Thank you.
Okay, thank you, folks. Bye-bye.
All right. Bye-bye.